In economics, we categorize firms into different types of market structures. These categorizations are based on a number of characteristics that are either going to be firm-specific or market-specific. Let's begin by looking at two opposing market structures, perfect competition and monopoly. Among perfectly competitive firms, we have these five distinguishing characteristics: many buyers and many sellers, homogeneous or similar goods or services, price taker, free entry and exit, and zero long-run economic profit. What makes perfect competition unique is that each firm only produces a tiny fraction of market output and can't control the price of the good they are selling. If they did try and change the price, then consumers would purchase from the other sellers who are selling the same good. Lastly, the perfectly competitive firm earns zero economic profits in the long run. This stems from the fact that many sellers are selling the same good, but more importantly because there are no barriers to entry or exit inside the market structure. Now let's compare perfect competition to monopoly. With monopoly, it's easy to see how different these two market structures are. Monopolies are price makers, meaning that they search for the price that maximizes their profit. Monopolies also enjoy long-run economic profits as they have barriers to entry such as controlling an essential resource, having large economies of scale, or granted exclusive rights to produce their good or service. Now consider monopolistic competition, which blends elements of perfect competition and monopoly. Begin with the perfectly competitive characteristics of many sellers, free entry and exit, and zero long-run economic profits. Now let's bring in the monopoly characteristics of price making. And now what we see that distinguishes monopolistic competition from the other two is going to be similar but not completely similar goods. This is what we also call product differentiation. Lastly, let's consider oligopoly. Oligopoly is closer to monopoly than perfect competition. Its similarities include price making and barriers to entry. What distinguishes oligopoly are the three characteristics here: few sellers, those that control a majority of the market that is, differentiated and undifferentiated goods, and interdependence. Interdependence is perhaps the most defining characteristics of oligopoly, as each firm has to consider what other firms are doing in terms of pricing and output. In fact, many economic models of oligopoly are built around this idea. While knowing the characteristics of each is important, we also need to be able to measure market structure to accurately determine which one we are considering. Here we have created a market structure spectrum with perfect competition and monopoly at the polar ends and monopolistic competition and oligopoly in between them. We know oligopoly is more closely related to monopoly, but what we need to know is how close monopolistic competition is to oligopoly. One measure that we use is the concentration ratio. In this formula, we are using the four-firm concentration ratio. It measures how much market share the four largest firms have in relation to total industry, or to the total industry. To find this measure, we add up the four largest firm sales and divide it by the total industry sales, and then we multiply that result by 100. Monopoly has a concentration ratio of 100 because a monopoly is the market and has all the industry sales. Perfect competition, theoretically speaking, has a concentration ratio of 0 or near 0 because all firms produce a tiny fraction of industry output. Economists in the Department of Justice have defined an industry to be an oligopoly if the four-firm concentration ratio is greater than or equal to 60. This lets us know that monopolistic competition will be somewhere below the 60 threshold. As an example, consider four fast food firms: Burger King, McDonald's, Hardee's, and Wendy's. In this example, each firm has sales of $1,250 for total sales of $5,000. If industry total sales are $6,250, then the four-firm concentration ratio is 80, and we can classify this particular example or this particular industry as an oligopoly. One other way to measure market power is to use the Herfindahl-Hirschman index. The Herfindahl-Hirschman index takes the sum of the market share squared and places them in an index from 0 to 10,000. From our previous example, each of the four firms would have 20% of the market, so their market share would be 20. So Square that market share of 20 to get 400. Next, add them together to get 1,600. So the 400 for Burger King, the 400 for McDonald's, the 400 for Hardee's, and the 400 for Wendy's all give us 1,600. However, we can't stop there because we need to include all the firms in the market. So the remaining firms would have to have their market share squared and then added as well. We can look at our polar cases here of monopoly and perfect competition and see that their Herfindahl-Hirschman indices are going to be 10,000 and 0 respectively. Because the monopoly is the market and its concentration ratio is 100 or its market share is 100, if we simply squared that 100, we would get 10,000. Theoretically speaking, because all perfectly competitive firms should have near 0% of market share, then their Herfindahl-Hirschman index should also be 0. Our market structures seem to be very different, but they do have a common theme. Let's begin by looking at the firm demand, marginal revenue, marginal cost, and average cost curves for perfect competition and monopoly. As you can see, the perfectly competitive firm has a horizontal or perfectly elastic demand / marginal revenue curve. This is because the firm is a price taker. The monopoly, however, has a downward sloping demand and marginal revenue curve because the firm is a price maker. Each firm has an upward sloping marginal cost and the familiar U-shaped average cost curve, labeled here ATC. What then makes these market structures and monopolistic competition and oligopoly alike? It's the simple fact that a firm maximizes its profit or minimizes its losses where its marginal revenue equals its marginal cost. We can determine this by looking at the revenue per unit and subtracting out the cost per unit. The resulting equation tells us how much profit or loss a firm earns per unit at its profit maximizing or loss minimizing output level. At this point, the firm has equated its marginal revenue to its marginal cost. That is, at this output level, the firm has no incentive to increase output because the additional cost will be greater than the additional revenue. Likewise, decreasing output causes the firm to decrease its profit as it could make more by selling the additional unit. The distinction made earlier is that two of our market structures earn 0 economic profits in the long run, and the other two could earn economic profits in the long run. This distinction arose because barriers to entry prevent firms from entering the market to take away economic profits from other firms already in the market. As an aside here, earning 0 economic profits is not a bad thing. It simply means the firm is earning a normal rate of return. That is, the firm is earning its opportunity cost of production. Let's first look at the perfectly competitive firm in the long run. You should notice that this firm's average cost is now resting on its demand / marginal revenue curve. At that point, the firm's marginal revenue equals its marginal cost, its average cost, and the price of the good. This means that the firm's total revenue just equals its total cost. The firm has no incentive to exit the market, nor do any potential entrants have the incentive to enter the market. Next, consider the monopoly. This is the same graph that was previously shown. The monopoly is still able to earn an economic profit in the long run. However, note that a monopoly is not immune to another firm eventually entering the market due to technological or cost changes. Lastly, consider the monopolistically competitive firm. This firm displays a downward sloping demand and marginal revenue curve like the monopoly. However, in the long run, its average cost sits on the demand curve like the perfectly competitive firm, but not on the marginal revenue curve. Because the firm's total revenue and total costs are the same, the firm earns a normal rate of return. But note that the price this firm is charging is above the point where its marginal revenue equals its marginal cost, much like the monopoly, and not where its price equals the marginal cost, much like with perfect competition. This creates an interesting difference for the monopolistically competitive firm that we're going to look at next. Here we're going to consider the implications that each market structure has on societal welfare. Let's start with the market structure that maximizes societal welfare. In perfect competition, sellers earn zero economic profit, and the interactions of many buyers and many sellers determines the price that each firm will charge. At the equilibrium market price, consumers and producers cannot do any better by altering how much is bought or sold. At the equilibrium market price and quantity, both the consumer and producer surplus are going to be maximized. Consider the monopoly next. The monopoly creates a scenario in which the consumer pays a higher price, one that is higher than the marginal cost to produce the good. In essence, the monopoly extracts consumer surplus from the market and turns it into economic profit for the monopoly. Notice the green area labeled deadweight loss. Because the monopoly is no longer pricing where price equals marginal cost, it causes a loss in welfare to the market as a whole. This loss in welfare is gone from both the consumer and producer. This is essentially an inefficiency that arises due to monopoly power. Or that is another way to say this is a loss in efficiency due to monopoly power. Lastly, consider monopolistic competition. This is the same graph that was previously shown. Now a new item has been added, and that is excess capacity, the distance between QMC, the quantity that the monopolistically competitive firm produces, versus QEC, the efficient quantity, or we could also say the excess capacity quantity. This is the output that the perfectly competitive firm would produce. Here, the firm has the ability to expand its production up to that point where the marginal cost just intersects the average cost. At that point, the firm would be providing the social optimum, at least from the consumer standpoint, but it would also incur losses. From a policy standpoint, politicians and economists have argued, well, we can't really do anything, and that it's actually might be more beneficial to allow this. Economists have largely given the monopolistic competitive firm a pass on this for two specific reasons. First, the firm is not earning any economic profits at its current level of output. Here, its price equals its average total cost, and P times QMC gives it its total revenue, and ATC times the QMC gives it its total cost. So its total revenue just equals its total cost. Next, firms are also providing benefits to consumers in the form of product differentiation. If you consider clothing as a general good is not going to be too differentiated. But once we start breaking clothing into different categories, we see that there's many brandings, many styles of clothing. This differentiation allows somewhat of a positive externality that goes towards consumers and is beneficial towards consumers. So given the fact that the monopolistically competitive firm earns zero economic profits in the long run, and we have the product differentiation, monopolistically competitive firms do get this pass on the welfare cost, even though they're not producing where price equals marginal cost.